Good Sunday afternoon, everybody. The 28th of March on what is now a very rainy afternoon. So good time to do a video. Just a quick plead. If you like what you see here, please give me a thumbs up on YouTube. And we are going to dive right in. A couple things we're going to cover today. Number one, we will cover some brief things about tax day, a webinar, and then quick comment about sentiment. And then I'm going to dive in and talk about what happened a year ago right now, which was the bull market bottom in the midst of the darkest days of COVID. So with that, let me say, I hope you're all well. I hope you're all healthy. And I hope you see at least a bright light at the end of the tunnel. It's been a long 12 months. It's certainly been I don't think it's been a long winter. I mean, it wasn't really cold. We kind of got lucky that it wasn't bitter cold. So I know we've dined outside. We were out with a couple in January. We dined outside at a restaurant, which that was kind of fun. I layered up in ski gear. They put a couple of heaters around us. We sat outside for 3 hours. So that was fun. In any case, vaccines are certainly plentiful in most places, especially Connecticut. So I hope those of you who can and want to get a vaccine get one super quickly. I got mine from Johnny John 3 weeks ago. I had no side effects, no issues whatsoever. So for me, it felt good to get vaccinated. I am still, as those of you who know me know, I'm on the skittish side about COVID, having lost a number of people. So I am not very cavalier about it. One of my longtime industry colleagues and friends, she passed a week ago. So it's still for me. I'm still skittish. I will always be skittish, and that's me. So let's move on to happier and better topics. Number one, tax day is moving to May 17th. You've got until May 17th to make your IRA contributions. Please don't wait until May 17th to get it postmarked. We know what's going on with the mail. Most things are getting there. It's taking weeks. Some things are getting lost. Get your IRA checks into us much quicker, please. It's so much easier when we're not running around crazy right before tax day. As you know, I'm a big proponent of moving tax day to the middle of May, but forcing the Fidelity, Schwab's, mutual funds, brokerage firms to still send their 1099s by February 28th so that accountants and tax preparers are not running around crazy over that 6-week period. Let's move it to May 17th. And let's still require the 1099s to be out in February. I think most people in the country would be a whole lot happier and things would run smoother. Don't forget your IRA contributions, please. Get them in sooner than later. Moving on. My quarterly webinar for clients where we review all of last quarter. We talk about our 15 investment strategies, how they did, why they did, what I think going forward, as long as the quarter that's coming in front of us and what I'm forecasting. That webinar, I'm tentatively looking at April 8th, 7:30. I will get back to you soon via email, but tentatively you can pencil that in April 8th, 7 or 7:30 for an hour. So look for that coming up. And with that, let's go on to, I'm going to talk about 2020. I'll make a brief comment now about the market. Number one, we still have epic greed and euphoria. The NASDAQ decline has not corrected that. You guys know I've been saying it on TV. I'm pointing to my TV behind my computer screen, and I've done my videos. The end of August, I wrote that piece about, oh my gosh, selling some or all of your Apple. And I got the usual, you're an idiot, hate emails, comments, blah, blah, blah. I don't really care. I did what I thought was right. Those clients who were in our stock strategy, I cut back their Apple holdings significantly. And I think that was the right move. It was a combination of having a bunch of overloved and overowned stocks, and then having insane greed and euphoria in one sector. So that's why I did it. I still feel the same way. I think it's a it could be a year-long story. I think that it's not new. You've read my forecast, you've seen the blogs. One of my themes for at least the first 6 to 8 months of the year, my themes are the same. Small caps over large caps, value over growth, cyclical, economically sensitive stuff over defensive and technology. That's been my theme since the, October 30th bottom. It remains my theme. Doesn't mean that Apple and any other company you may love for whatever reason is going to zero. I just think, and I continue to think, that the market is going to value other companies more for now. That's my theme for now. That's going to change. As you know, I never have the same theme over and over and over and over again. I will take a look at the data, look at our models, and I'll give you my forecast based on that. So let's move on. And let's talk about a year ago. So I am going to share my screen. All righty. A year ago, we know, so where are we? March 28th. So a year ago in 6 weeks was right here where the market saw its all-time high. From there, and look, we knew COVID was around in December. COVID was in December. What happened? What did the market do? The market just roared higher because every pandemic prior to COVID, stocks roared higher. Didn't care about the pandemic. And that's what I thought too. I mean, people in revisionist history, everyone saw COVID coming. Everyone saw the market down 30%. Everybody sold at the top and bought at the bottom. I know I didn't. I played defense appropriately. Some strategies played defense super quickly in February, and they did great. Other ones played moderate or modest defense along the way. Some didn't play any defense. So I'm not a revisionist history guy. I have no problem looking at my mistakes. If today was, last February 19th, would I have done anything different? No, because look up here, the markets looked fine last February at the peak. All right, they did. And then what happened was this day. This is a really bad day for the stock market. And for me, that was a little bit of a because that was not supposed to happen. And it's very telling when something happens in the market that's not supposed to happen. That's a bell ringer that you better reassess. So that was the day I said, gosh, not supposed to happen. Something's not right. And boy, the next day we fell even further. So essentially, over 2 days, stocks fell roughly 10%, a little bit less. And they fell in pretty dramatic fashion. By the end of February, we were down more than 10. But I thought as the bulls kind of gathered themselves below 2,900, things were going to at least start to moderate. And for a couple of days, they did. Markets bounced back sharply, and we had a decent week. The problem was that COVID got worse as we saw it moving around the world. The seminal event, the seminal change that was the bell ringer that this is not what happened every time before, besides stocks cutting loose at the end of February from an all-time high, which had never happened before like that. But the big change was we started talking about closing down the economy. Stocks trade on economic activity 3 to 9 months down the road. Stocks trade on economic activity 3 to 9 months down the road. Don't ever forget that. What you hear and see and feel today is completely irrelevant to the markets. Stocks trade looking down the road, not right in front of us, not in a rearview mirror. So that's what changed in the market when it became accepted that the economy was going to close down. That's when the markets unraveled a third, roughly 30% of their value in a month. It was, as you know, I'm not going to rehash everything, but it was the shortest, sharpest decline from an all-time high in history. That was a tough one. That was because usually a decline of 30% happens over months, if not quarters. And there are intervening rallies in between. Not in this case. This was literally from the all-time high last February 19th. Markets just really plummeted. You had that little tiny rally, which looks better right now because I've expanded my screen, but you had this little rally in here for over a couple of days. But for the most part, I mean, they just cut them loose. I actually thought where I was wrong was I thought this period in here saw a good opportunity to get the market back to 3,300 and then perhaps roll over. Well, I was wrong. It didn't. They cut them loose again. And on March 9th, which is the day you can see here, our models indicated something that's only happened a handful of times in 30 years. The last time was Christmas Eve 2018, which led to a meteoric rise from there. And before that, there were a couple other times, the crash of 87, October 1990, October 1998, X number of times right after 9/11, where these conditions were met and there was normally an enormous run back, at least 20% pretty quickly. So that's what that condition began on March 9th. It wasn't the bottom, frankly. We didn't bottom for another what, 2 weeks, a little less than 2 weeks. But what happened, you'll see as we march on, there were no intervening rallies. The most fascinating part of when the markets really started to roll over, we had this one little rally for a couple of days, but beyond that, every single rally day was met with more selling. Think of how many times we came into work, I came into work, and the market was indicated down 5% at the open. It happened a lot. I wrote about it. I mean, gosh, go back on the blog. I don't edit anything. I don't revise history. You guys know that about me. I have no problem saying I was wrong. I've been doing this 32 years. I've been wrong more times than I ever want to count, but I learned from it. And that's what investing is all about. If you don't learn from your mistakes, you're never going to be a successful investor. So we came in so many times, we had a one-day rally and then another decline, a one-day rally, then another decline. So when that happens, what do you say? The first thing you say is, boy, what happens if we get a two-day rally? That could have broken the back of the downward momentum because all we had were essentially one-day rallies. So look, let's look. Since the high in February, we went down, 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 down. The first rally day was here, and the next day was down. Then we rallied, and then we were down, and we were down, and we were down, and we rallied, and we were down, and we were down, and we rallied, and we were down, and we rallied, and we were down. So looking for just a two-day rally would have been something different. And we still didn't see. So that this was March 23rd was the low, 3,400 down to roughly 2,200, roughly a third. I'm just rounding because I don't need to do the math and the numbers right now. That was really a crash over a period of 4 weeks. That was, as I call it, the COVID crash. Not a single two-day period where we rallied. And in hindsight, this is so easy in hindsight. You know, you look at all the pundits, and on the blog, I make fun of them a lot. You've got an epic, one of my favorite words, an epic number of complete and utter clowns doing punditry on TV now, because all they do is revise history. Everybody sold at the top, they bought at the bottom, they've hit which is nonsense. It's nonsense because, frankly, in the land of punditry, if you look, most of the pundits on TV, not all, most of the pundits don't even manage money. I know you're going to say, how could that be? You can go Google. Some of them are brokers, floor brokers, brokers at firms, but most of them do not manage client money. I know, it's insane. How could they give advice, and why would you want to take their advice if they don't manage money themselves? I ask that question all the time. It's very easy to say you're nibbling and you're trimming when all you have is your own little tiny portfolio. You don't run it for clients, because it's a lot harder to run money for clients than your own money, because there's accountability there. So in any case, I'm getting off topic. We had the COVID crash, 33% roughly in a month. What that told us, economic activity 3 to 9 months down the road was going to absolutely crash. And you know what? It did. the market was right. The market told us what was coming. What happened in Q2? The single largest economic plunge in history. The economy dropped on an annual basis 30%. Q2 saw the economy contract 30%, worse than any other time in history. That's why the market collapsed what it did, and that's because we closed the economy down. So on March 23rd, 24th, again, so I'll take a little bit of a victory lap. I'm not, I certainly, I have a little bit of an ego. I wrote a blog, and then I went on Fox Business with my friend Charles Payne, and I said on March 23rd, the day of the low, look, I'm looking for a bottom right in here. Monday, Tuesday-ish, we should see a low, a capital low. I didn't say it was the low. I said it was a low because each successive down day was coming with less acceleration to the downside. So prices were still falling, but the stuff we look at wasn't falling as hard as the previous down day we saw. So things were falling with less power. And when things fall with less power, it means that they're getting slightly better and the turn is probably coming. What I thought was going to happen, I thought we would see the bottom on March 23rd or March 24th. We did, but I thought we'd rally for 2 to 4 weeks. There'd be another decline, and then the new bull market would begin. Okay, so what really happened? Well, I was right about the 23rd, 24th. We did put the bottom in, and we did start to run higher. And you can see that. And I remember saying after a couple of weeks, into April, boy, it'd be a nice spot for stocks to turn lower on almost no downside acceleration. Maybe we could get a decline to the downside that so many stocks didn't go to new lows, but that didn't happen. And instead what happened was stocks barely paused all the way to June. Wow. So now you look, and you say, all right, we've had this big decline and we bounce back. So remember I told you, let's look for a 2-day rally. Well, right off the bottom, here is your 2-day rally. Day 1, day 2, day 3, 3 days up. That tells you right there, something was different. Also fascinating was right near the lows, there were articles written, Wall Street Journal, interviews on Fox Business, CNBC, Bloomberg, people actually advocating that we should close the markets, stop trading altogether, let the virus play out. I'm thinking, first of all, that is a ringing bell that markets are bottoming. If they're talking about closing the markets, I mean, that's insane. Could you imagine if you could not get access to your money? You've got money in a mutual fund, in an ETF, in a stock, you need money to live on, and we close the market? And talk about a permanent loss of confidence. Let me tell you, that's never happening. The price discovery, the ability for markets to freely trade is the hallmark of capitalism. They're not going to let in 2021 the markets close. That I felt confident about. But that was certainly a sentiment sign that, boy, we're getting close to the bottom because people are saying we should close the markets. Also, a number of these pundits on these shows, these trader shows, which I thought was so fascinating, all of a sudden said, well, the S&P, and the funny thing is, it was the same number. It was S&P 1500, which, my gosh, after going down to 2,200, they're talking about another 700 points or another third off the market. And it wasn't one here and one there. It was so many of the same clowns who got the whole thing wrong to begin with. The brokers, I mean, you got guys who are writing newsletters on some of these shows and who are floor brokers and strategists for big companies. S&P 1500, they just kept saying it, starting in here and then all the way during the rally. It's like, nope, we're going down again. I remember when the market started to rally and it was 20% off the low, and I was a little snarky on Twitter with Brian Sullivan and Guy Adami when I said, by everyone's definition, a 20% rally means a new bull market. And one called it ludicrous, one called it ridiculous. Well, they were both wrong, because this was the bear market low, March 23rd. And we absolutely ripped from there. So now, again, hindsight's so easy. If I can manage money in hindsight, holy geez, I'd be, I don't know, I'm happy. I'm a happy guy to begin with. I don't know, happier? I don't know. I kind of like what I have. In any case, as we began to rally, and I suspected that we weren't going to have this rally and secondary decline. I started writing, as you know, last May, that this is, in my view, definitely a new bull market. And in new bull markets, they almost never decline more than 10% in the first year. It's a rarity. So essentially, if you know they don't decline more than 10%, anytime you get a decline in the first year, you buy the decline. That's the easiest thing in a new bull market. You buy weakness, because it rarely comes. And what they do is, as markets run, especially off the bottom, they really get you in that they push so hard higher, and they leave almost everyone behind. It's very hard to jump on board of a market that really only has one down day at a time, or maybe two down days at a time. My old hedge fund boss, Steve Oristaglia, used to say to me, in bull markets, when you're sitting with cash, look for that 1 to 3 day decline, because that's usually all they give you. And that's true. Off the bottom, they gave us 1.5 days down, and that was it. And we ran all the way from March 23rd to early June. And this last run became the reopening trade. Everyone said their economy was going to reopen. They were wrong, obviously, because it took a lot longer. But this period here, so many people turned negative and said, now we're going to roll over. Now we're going back down again. Now we're going to go below the lows of March 23rd. Now we're going to see S&P 1500. As you know, I was definitely not one of them. I may have screwed up along the way and gotten it wrong. But once we started to turn, I was a proponent of buying every bout of weakness. And as you can see, by the time August came, the market tested the old all-time highs from February. Now, to be fair, in May, I thought we'd be at all-time highs in Q1 of 2021. And I thought I was among the only ones saying that. And that was really bullish, but markets were so amazingly strong and resilient. Why? Because the Fed, unlike 07 to 09, and certainly unlike the Great Depression, the Fed did the unthinkable and unfathomable back in April, which I won't rehash, but they threw trillions and trillions at the markets, and Congress started to throw trillions and trillions at the market to replace what was lost economically. And that's why the markets have ripped higher ever since. Markets are not rigged and manipulated to the degree that the Fed pushed a button to decide where it's going. But when so much money gets thrown at the market, yes, markets will rise. All markets will rise when money gets thrown at it. So now you can see what we took out the old all-time highs here. We ran, we pulled back in. More people got really negative in here saying, oh my gosh, this break higher was fake, and it was false, and we're going to go down. You know my thinking. I said at the September, in this period, buy. I feel like that clown on TV saying buy. In any case, the real bell ringer for me, as you know, you can read in the blog, I was very confident, highest conviction I've had in a long time, that the markets were going to bottom right before the election. And they did on Friday, October 30th. I couldn't have pounded my fist anymore. I couldn't have gotten any more aggressive with what we owned in our portfolios. And that really took us all the way into the new year. So that's a quick review of the COVID crash and the ensuing rally. It was really one for the ages. And now we are, I don't know where we were here today. It really, I always say, I think I've seen it all until I saw something new. I remember the crash of '87 vividly. I was in college, and a buddy of mine and I, it was the first time I started creating computer models. And a buddy of mine and I, well, more my buddy than me, but the model we created told you that the markets were going to have a big problem, over the next couple of weeks. This is, I think, October 3rd or 4th, 5th of 1987. I had one stock, American Standard. My grandfather gave it to me. My grandparents gave it to me for my bar mitzvah. And I sold it. I said, oh my God, this model we created. And then the market crashed. I bought the same stock back. And I said, wow, that was fun. So ever since, I've enjoyed trying to model markets. They're always changing and evolving. Models that work during one period fall flat in their face in other periods. That's why you need multi-models, multi-duration, multi-factors. This is not like picking a moving average and saying, I'm going to buy when the stocks are above a line and sell when they're below it. It doesn't really work out that well. But here we are today. And I think that's probably enough. If you've watched this long, bravo, I thank you. You probably have nothing better to do this afternoon or this evening or wherever you're watching it, but I thank you for watching. I'm very appreciative of our followers. They've grown each and every year since I've been doing this. And I hope, God willing, I'll be doing this for at least another 20 years because I enjoy it so much. That is the truth. And let me stop sharing. So I think what we'll do now is our next video, I will work on getting a sense of where we are today, what looks to be happening going forward. But markets are trading fine, except for some shallow and brief pullbacks. The markets look fine. We have greed, we have euphoria. In those kinds of companies and areas, they're going to get punished. I don't think it's in the right here and now, but we'll always look. I think there's something else coming later this year, which we'll talk about another time. Again, if you like the video, as always, please give me a thumbs up on YouTube. If you want to offer your questions, comments, or concerns, as long as they're respectful, please email me, paul@investfortomorrow.com. If you want to schedule a Zoom or a call or a Skype, you can do so via the website. There's plenty of spots. I wish I should have pulled it up, but I won't. So with that, again, I hope you're staying healthy and sane. The weather's getting good. We can all get outside and get some sort of normalcy back in our lives. So with that, I say, I hope all is well. Enjoy the rest of your day and whatever day you're watching this on. And we'll see you soon. Bye-bye.